have kind of postulated a building with the following characteristics. So this is a Class A building with 500 units. Just to make it simple, average rent $1,500. Normally you're going to have different layouts and different rents, but we're just going to say $1,500. You've got an expense ratio of 45%, which means basically 45, whatever your rents that you're taking in, 45% of that is going to expenses. We're not talking about debt. That's different. We're just talking about this on an operating basis. And this is the exit cap rate is 4% in the market. So, and we assume a 5% vacancy rate, right? Which is just kind of normal underwriting, right?
Yep.
So maybe more, maybe less, but just for underwriting, you're going to assume that. So let's see what happens. This is our base case, right? So at 5%, your top line rent roll is $750 a month, or $9 million a year. You've got 5% vacancy, which is $450. So this is your effective rent here per year, 8,550. Okay. Your expenses come out to a little less than 4 million. So your net operating income here is, 4.7 million. And at a 4% cap rate, that implies a price of over $117 million for this asset. Okay. Yep. Now let's just see what happens when you start changing some of these assumptions.
Yeah. And when we do this, this is what I'm trying to paint this picture for folks. So pretend like this is a December 2019 deal, right? COVID's nowhere to be found. Everybody believes the urban core is the best place to be. Class A, nothing can go wrong. I'm gonna come in at 4%. I know it's low, but I'm gonna be good because there's rent growth. Millennials don't want to go anywhere. Blah 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 blah. The world is good.
And what the people buying that are probably assuming is that the number here that's going to change is this number right here, this $1,500.
Number 2, yep.
Right. So they're assuming that this is going to go to 1,600, and let's just see what happens if they're right. Now you've added, by raising your rents $100 a month, you've added $8 million to the value of your property.
Congratulations, you're a millionaire.
Yeah. So, but let's go back to 1,500. All right. Our base case. And let's just see what happens if you get just a little bit of vacancy, right? So let's just say your vacancy now spikes up to 7%.
Okay.
Now, you've lost $2 million off the top, right? Your NOI is off by $100,000 and you lost $2 million of value at a 4% cap rate. Okay. Let's take that back to 5. Let's see what happens if your expense ratio goes up. And we're going to do these in isolation and we'll do them together. So let's just see what happens if your expense ratio goes up to 50%, because now you've got more turns, or maybe labor costs more, or, who knows what, some kind of inflation
could easily happen.
Could easily happen.
Oh,
so, right. So you've lost $10 million of value by having 5% more expense. Right. You've lost 500K of NOI, and that translates at a 4 cap to a $11 million loss of value, right? So let's take this back to 45%. And now let's just see what happens when the cap rate moves against
you. Well, actually do rent first.
Rent. Okay. Let's just say rent goes down $50 on average, right? You've lost 4 million of value just from that, right? Because your NOI has dropped by a couple $100,000. That's just for for a small, a small rent decline. All right. So it's about 3% rent decline.
Okay.
All right. Now let's see what happens with cap rates. Now, right now I've got a 4% cap, and, you're expecting, this is not going to change much over time. But let's see what happens if it does. So if you just go up 1 point to 5%, everything else being held equal, what happens to the value of your property? You lose $20 million.
$23 million.
$23 million by having the cap rate go up by 1 point.
So let's talk about that, because I got a lot of heat when I did my math, because obviously cap rate has a disproportionate impact. They're like, ask Jonathan, could that happen? Blah, blah, blah. And again, cap rate is essentially, it's a measure of risk. And if the urban core is deteriorating, more crime, not as clean, less people, it is very reasonable to think a cap rate might go up at least for a couple of years. Yeah. Is it not?
Yeah. And they do. Like, cap rates compress and decompress. Yeah. Right. And what happens during a frenzy is, usually there is a a point or so spread between the classes.
Mm.
So you could plot it out sort of on a 9-box grid, right? Where
Okay. Yep.
if you think about like, if you've got primary market class A, right?
Yep.
That, and then you've got, so class A, you've got primary market, secondary market, tertiary market, and you've got ABC.
Got it.
Right? So 9-box grid. Starting with the class A primary market, in normal times, you're going to get the next box over class A tertiary market, you're going to get 1 point higher cap rate. Secondary market, tertiary market, so 1 point each. And then down the thing, so class A, class B, class C, you're going to get basically a point spread within the same market, usually, or sometimes more. Okay. So by the time you get down to, if you go from class A primary market to class C tertiary market, you're now talking a pretty big spread between those, it's not going to be a 9-point spread, but it's going to be, there's probably about a 4-point spread overall cap rate wise to account for the risk of class C tertiary market. However, what happens in a frenzy like we've been in is it all compresses.
Yes.
So that the cap rates compress at every stage, but they also converge on each other more.
Yes, they do.
So what actually happens is that class C tertiary market property becomes more and more risky because you're buying it at less and less of a discount to the best properties out there, right? And so what'll happen is when the things go in reverse, there's a flight to quality, which means that, risk, the cap rate is essentially a reflection of risk appetite.
Yes,
right?
Correct.
The lower the cap rate, the less risky people feel the market is. As they feel it's more risky, they're going to want to get more of a premium for that dollar of investment. So what'll happen is you'll see cap rates decompress at every stage, but they'll also decouple a bit from each other too, so that that convergence on each other is going to deconverge. And starting with the perceived riskiest assets, which are going to be those C-class assets in tertiary markets, are going to decompress more, and that spread is going to widen out again, which then is going to make it a great time to buy those properties again. But for the people who bought at the top when they were paying, they could have got a class A property in a primary market for 4 cap, and they have only paid they paid a 5.5 cap to get a C deal in a C market, right? Those people are the ones who are going to get really whacked if they have to refinance or they have to sell.
Yep.
While the market is in that decompression phase. So anyway, so the answer, this is a long way of answering your question, but there is cap rate decompression. It happens in every market cycle. There's compression, decompression, and really sophisticated investors. The real value add game back, 5 years ago was you wanted to buy an asset at a certain cap rate and move it up to another class so that you could take advantage. You could force cap rate, compression by improving the asset.
Exactly.
Right now, everything is so compressed already.
Yeah, there's not much variability.
There's not much variability in there, but that was kind of like the real
It's
value
coming.
add strategy. It's coming again, but you have to be able to buy at a discount in the first place for it to work. Right?
Yeah.
So, but anyway, so this is just what happens when you get a little bit of cap rate decompression. You can see that just moving up, and 1 point move in cap rates, this is completely, completely normal.
I agree.
I'll show you just like a real world example. So Atlanta.
Yep.
All right. Atlanta at the top of the market, the last cycle, you were buying class A at like about a 4.5 cap rate, right? Okay. So that implies $104 million for this deal. But at the end of cap rate decompression, it was at 6.1. So let's see where that takes you. $30 million move.
Yeah.
Because
if you have to refi in that, you're toast. There's no equity left.
Yep. It's a 1.5 point, just a 1.5 point move. And
again, this is absolutely possible, and we have historical examples.
Yeah, this is what happens, right?
I want you to say that because people gave me grief and said, talk to Jonathan.
Well, yeah, people have been fooled into thinking this can't happen again.
Yes.
Or they've been, I wouldn't say fooled, they've been lulled into thinking this can't happen again. And usually the argument goes something like this. interest rates are going to stay low forever.
Mm-hmm.
So
The
therefore,
system is awash in cash.
cap rates will stay low forever. However, let's,
Exactly.
you know how low interest rates were around here?
Yep.
They're like where they are now, right? And you had cap rate decompression going on in this period because people were moving out and this vacancy spike happened, and investors felt riskier. You know, they were less inclined to buy this stuff. And so
you're right.
This is what happens in real life, right? Interest rates only matter, that relationship only matters when in the upswing.
Yeah. And again, what I'm pointing at here is all of this is an assumption that basically is built around millennials only want to rent. They want to be downtown. They don't want to own homes. It's too risky or whatever. All of this, all the people that were giving me grief are not realizing that the consumer, the renter of Class A urban is changing. And it's changing quickly. And it's been going on, to your point, for years, which I missed. But now, boy, the gasoline is on. It is accelerating, and the numbers are going to be ugly for a while.
It was a trend that was not really noticeable before, but it had started, right? But now it's really this has caused it to kick into high gear. All the people who are procrastinating, and frankly, with interest rates dropping as low as they have, it's poured fuel on the fire. I lived this story. This is exactly what happened right here, right? Interest rates were, reduced to basically zero, and everybody who ran out and was buying a house, right? Exactly. They just weren't buying them in the suburbs necessarily, but they were buying houses like crazy. And so now let's talk about.
Yeah, what I want to show folks is how easy a Class A building that you think is uber or very safe could be worth 50% less very quickly.
Right. So
it's a combination.
Now the thing that you have to understand is that all these things will move together, right? So
exactly.
That's, because if rents stay the same and vacancy stays the same and expenses stay the same, right? People's risk appetite may change a little bit, but it's not going to change that much. Yeah, exactly. So maybe this is going to move up a little bit that should, you can't really see that, but that's, where's my thing? That's 4.5% now. Yeah. Right? You can see 4.5%. Yeah. So it's gonna move a little bit, and chances are like you're basically riding this out, right? You don't have to refinance, you're cool. But here's what happens. Usually this number is going to move because these other numbers are moving.
Exactly.
Right? So what's going to happen? Let's just say your vacancy starts to climb, right? And let's just say it gets bad. It goes up to 8, like we've seen it's possible.
Yeah.
What's also going to happen then is your effective rent is going to decline because you're going to be making concessions, right? Absolutely. To try to get people in. So
Manhattan is 10%, San Francisco is 20% already.
So even if the top line rents don't drop, because landlords really hate dropping the top line rent, they're going to give concessions. So maybe you're getting 2 months off, right? So that's let's just say that it equals 10% decline in your effective rent. So now you're down to $1,350.
Yep.
Right. There's another 10 million lost in value. And now
we're not done yet. Expense ratio.
Yeah. Let's say your expense ratio now starts climbing because you're just doing more turns.
Exactly.
Whatever's happening. Right. You've lost another 10 million. And now all this is going to be now reflected in the risk appetite of investors. Yep. And this is going to move up to, let's just say 5.5%.
Okay.
Right. Now you're down from $120 million asset to a $67 million asset. Your mortgage, let's just say if you mortgaged, it was 75% before on your $120 million deal, right? That was in the 90s. Now you're like underwater by $30 million. And if you are unfortunate and have to refi this deal right at this time, you would have to raise $30 million just to pay off the debt. But of course, nobody's going to give you $30 million to put into this in a property that's now worth.
Well, you would need, in reality, you would need 50 million, right? Because you would have to refi it. They would do an LTV of the new value.
That's true. Right. So
it's 50 million.
Yeah.
There's no chance you're going to hand the keys back.
Yeah. So Exactly. So you're just walking away from this because you can't make it survive.
So again, all the money you raised from all your friends, right? Gone, right? The bank has to take a big haircut. That's why I think the loan loss reserves that the banks are taking is not so much for single family homes because they're just treating them different. It's all this commercial stuff.
Oh yeah.
Just got compressed. And we just walked through not even crazy moves. A 10% drop in effective rents. We're already seeing it. An expense ratio increasing 5%. I've seen worse. Vacancies up a couple of points. Man, just wait, especially when all the inventory comes on. Oh my God. And then all of that, to your last point, leads to a higher required cap rate. Yeah, easy. So your math is very similar to mine. You could take a building worth 120 and bring it down to 70 very logically.
Yeah. I mean, and look, this won't happen. Hopefully for most people, this will just be on paper. This number won't come to bite them, right? But
it's going to bite some.
But it'll bite some who have to refinance right in that period.
Mm-hmm.
And even coming out of it, let's just say that now you've gone on a couple of years and you've climbed back, and now you're back to say back up to 6%. You kind of got your rents back up to,
a little bit,
just down by a little bit. Right. And maybe, you're still way underwater. Right.
Yeah. Even if you took it to 5, even if you got halfway back.
Yeah. And if you get to,
you're still
back to 5 cap, you're still
underwater.
Yeah.
I mean, you're under the loan. That's not even underwater. You're under the loan amount.
Yeah. No, that's what I mean. You've got your equity is gone, and your building is worth less than the debt.
Folks, I'm going to be buying as many single family homes the next 3 years so that I can 1031 into commercial buildings, because this is happening. It doesn't happen overnight. It happens over quarters. And again, commercial lending forces some of this because it's short. You can do bridge financing, or the debt forces reevaluation. There's going to be so many technical defaults, right? Because isn't part of the paper say you have to be at some loan ratio? There are going to be technical defaults everywhere.
Yeah, and sponsors will be removed from operating the asset, even if there's no foreclosure, because the banks have the power to remove the sponsor if the asset's not performing.
Exactly.
So we're going to see banks have the power to replace the management company, right? So we're going to see a lot of things like that happening. Now let's tell the happy story though.
Okay.
So now let's say, what happens if you're able to now buy this asset?
Well, let's bring it down to where we were, because that's exactly what I did last time, right? So let's go at the top again.
So we're
right?
5.5. And we're at 1350.
Yep.
50. All right. So
and vacancies were 8. Sorry, just so we can get back to where we were.
Oh yeah. So if you're buying, and this is where a lot of people now, when you hear the story, multifamily does well in a recession, a lot of the assets were bought like this.
Exactly.
In 2005, 2006, when everybody was buying single family homes, right? Mm-hmm. Because this is what the numbers looked like.
Yeah.
Right. You were up at 8% vacancy, right? They weren't underwriting a lot of rent growth because.
And you know what? So let's just be honest with each other. What's going to happen because this will happen.
Yeah.
More and more people are going to start hearing multifamily. They're going to hear about bankruptcies and billionaires becoming millionaires. They're going to hear all this and they're going to run away. They won't touch multifamily. And then guys like you and I will come in and scoop these assets up for.
And that's why the cap rate rises, right? Because everybody is frightened. But the really sophisticated money is going to look at these numbers and they're going to say, gosh, this asset was trading at 117 2 years ago, right? A lot of people will look at this and say, oh my God, how much farther is it going to fall?
Yeah.
Right. That's the kind
absolutely.
of that's the retail investor mindset. Like, oh my God, it just fell by 50%. It could go to 0. Whereas, the sophisticated investor will look at it and say, it's now been de-risked. It's fallen by 50%. Maybe it'll go a little bit, it'll there's a little more to go, but basically I know I'm going to go buy this with 10-year paper.
Yep.
And I know that 10 years from now, this is going to be worth more. So let's just go back.
Hold on. This is what I said when I was buying apartments at these kind of prices, not these numbers, but these ratios, is I couldn't build it for that price.
Right.
In this case, the guy's, smart money is going to say, I couldn't build that thing for 80 million. I might as well pick it up for 67.
Yeah. And right now we're in exactly the opposite situation.
Exactly.
where, you know, the logic is if you can't buy it for the price that you want to buy it at, you should build it. And so that's why
that is today. Yes.
So that's where we have been today, although that's about to change.
It's been time.
But if you're then in the situation where you can buy for these prices, right, then you don't really need very much to start, you know, to start making money. So let's just say that this is the price you're able to buy it at, right?
Okay, so I'm gonna knot it down because this is gonna climb up just like it fell.
Yeah. So let's just say you just are able to. Economy starts getting a little bit better.
Vacancies will fall.
Vacancy starts to first. Yeah, exactly. So you're down to 7% vacancy, right? Yep. You've added $1 million bucks already, yep. Right? Yep. And you start moving up. You move to 6.
Yep.
You're now up by another couple $1 million bucks just on vacancy, right?
Yeah. Which will happen.
You get down to your 5, right? That's the signal that you start raising rents.
Exactly.
Right. So once you're down at 5, then because 5 is kind of where you want to be. Yeah. Really for vacancy. So
5's the running average.
Now let's just take it up to $25 a month.
Another $1 million bucks.
You're another $1 million bucks. Another 25.
Another $1 million bucks.
Right. And you're just moving up. And as this goes up, right? Let's take it back to 15. As this goes up, what's going to happen? All the people who've been sitting on the sidelines are going to start saying, "Oh, look at multifamily." Exactly. So now your cap rate's going to go to 5.
Exactly. Right? And boom, there's $8 million bucks.
Now you're 4.5.
There's 10 million.
5, right? Yeah. And now we get back down to 4 at the top of the cycle, and here you are. And that's, you know, we still have the same expense ratio. We haven't changed that. I don't think that's going to change much, but that's, you've gone from in a couple of years.
Yeah.
You have, with the wind at your back, the market has taken you from 67.
Yep. To basically 107. So 40 million bucks.
Yeah.
Easy.
That's how it works. And that's, you know, obviously timing is difficult, but when the signal is, you know, when you see the cap rates rising and when you see people complaining about multifamily or saying it's too risky or it's not a good asset to own or whatever, that's,
and this is what the rich or the smart money will do. They'll manage. This is probably a 3-year journey, right? Getting rents to back where they were, vacancies down. But then what happens? Well, you refi the building and you take all your cash back and now you're into the building for 0.
Yeah. And this is why we have seen this massive buildup of cash on the sidelines, because people have been waiting for exactly this scenario to happen because they know that it's going to happen and they know that the latecomer operators and buyers are the ones who get slaughtered and they're going to be able to buy those assets super cheap, right? So there have been people who've been telling me, oh, well, the market can only fall by 10% because there's so much money on the sidelines. That money is not waiting for the 10% discount because it knows what the scenario, it knows how little has to change for the real bargains to occur, right? So they're not looking for the 10% cap rate, you know, decompression that happens. They're looking for that spike in vacancy, right? And the declines in rent and the combination of those things that then is going to force a cap rate reevaluation. And when the cap rates get pushed up, that's when you're really going to see.
So I am standing by my thoughts from earlier in the week. I've now validated with Jonathan. They're at least possible that the urban core class A in big cities, not the riskless asset that we all thought they were.
This is a scenario that is not. This is a plausible scenario. Let's put it that way.
Possible.
Right? Yeah. Whether it happens or not, we don't know. But this is not. As you see, we didn't have to change much to really crash the value of that asset.
And it really, to me, it all starts with that assumption that we're making that this time is going to prove wrong. The millennial always is going to rent. That is the first domino that causes all of these things to change, in my opinion.
Yeah. Well, and look, even if it's not that, I mean, just with unemployment and everything going up.
True.
Because we've seen,
that's true.
You know, I wish we could get this with an overlay of the unemployment rate, but you can just assume that in these blue bands, you have a big jump in unemployment. For sure. Right. And so vacancy goes up. This is the thing that I've just been scratching my head for years as I've heard people say, oh, in recessions, it's great for multifamily. Because I'm like, on the basis of what? People don't have jobs. Yeah. How are they supposed to pay rent? Right. Exactly. So And this just show the data is there. All you have to do is look at the data and it will tell you,
Yeah.
you know, so.
Oh, very cool, man. This has been so much fun for me. I'm glad we were able to go through this, and I'm glad I wasn't way off. It is possible. That was a big deal for me. So thank you.
It's just math. You can do math.
I can, but I was starting to wonder if maybe my assumptions were wrong.
Well, listen, I mean, I've been through that too. After hearing enough from other people that, oh, multifamily does well in a recession, or, you know, better in a recession, you even hear, I was started scratching my head and it's like, this can't be true. So I went and talked to my property manager who's been in the business for 40 years. And I said, look, I need a reality check because I'm just hearing so much noise. What, you know, does multifamily do better in a recession? He just sort of laughed at me, you know, like, so.
Very, very cool.
Yeah.
Well, I appreciate you doing this, Jonathan. Thank you very much. You have a wonderful week.
You too, Michael.
Thank you.